Listen to me. If you are sitting on company stock inside your 401k and you are getting ready to retire, or if you just retired, you need to stop everything you are doing and pay close attention right now. Because the single biggest mistake I see retirees make when they leave a job is blindly rolling their entire 401k over into a traditional IRA. They think they are being smart. They think they are playing it safe. But if you have appreciated company stock in that account and you blindly roll it over, you might be throwing away tens, or even hundreds of thousands of dollars in unnecessary taxes. That is money that belongs to you, money that took you decades of hard work, sweat, and sacrifice to build. So today, we are going to talk about a powerful tax rule called Net Unrealized Appreciation, or NUA, and whether it is a brilliant tax trick or a dangerous trap for your retirement cash. Let us get very clear on the problem. When you leave a job or retire, you have got your 401k sitting there. Inside that 401k, you might have stock of the very company you worked for. Over the last 20 or 30 years, maybe you bought that stock at $10 a share, and today it is worth $100 a share. That growth is massive. But here is the fear that keeps so many retirees up at 3 o'clock in the morning: how much of that hard-earned growth is Uncle Sam going to steal when you take the money out? Normally, when you take money out of a traditional 401k or a traditional IRA in retirement, every single dollar you withdraw is taxed as ordinary income. Depending on your tax bracket, that could mean handing over 24%, 32%, or even 37% of your money straight to the IRS. That stings. So people ask me, Susie, isn't there a way to get capital gains tax rates instead of income tax rates on my 401k? And the answer is yes, but only for company stock, and only if you follow the NUA rules to the absolute letter. Here is how Net Unrealized Appreciation actually works in plain English. NUA is simply the increase in value of your company stock from the price you originally bought it for inside the plan, what the IRS calls your cost basis, to what it is worth today. Under the NUA rule, instead of rolling that company stock into an IRA, you move the physical shares directly in kind out of your 401k and into a regular, taxable brokerage account. When you do that, you pay ordinary income tax only on the original cost basis of the stock in the year you make the move. The huge pile of growth, the net unrealized appreciation, is not taxed right away. And when you eventually sell those shares, that entire growth portion is taxed at long-term capital gains rates. In federal tax terms, long-term capital gains rates are dramatically lower than ordinary income tax rates. We are talking 0, 15, or 20% instead of paying up to 37%. That is an immense difference for your life savings. Now, do not run out and do this tomorrow morning without listening to the rules. The IRS gives you this incredible benefit, but they make you walk a very narrow tightrope to get it. If you mess up one detail, you destroy the entire tax strategy. Rule number 1, you must have a qualifying triggering event. For most of you, that means separating from service when you retire, turning age 59 and a half, or becoming disabled. Rule number 2, you must take a complete lump sum distribution of your entire 401k account balance within one single calendar year. That does not mean you have to cash everything out. It means your entire 401k must be emptied by December 31st of that year. The company stock goes in kind to your taxable brokerage account, and all the rest of your investments, the mutual funds, the bonds, the cash, can be rolled over directly tax-free into a traditional IRA. So how do you know if NUA is right for you, or if it is a trap? Ask yourself these critical questions. First, what is your cost basis? If you bought the company stock years ago when it was dirt cheap and it has grown tremendously, NUA can be a goldmine because your upfront income tax bill on the cost basis will be tiny compared to the tax savings on the growth. But if you bought the stock recently and the cost basis is high, or if the stock hasn't grown much at all, paying ordinary income tax on that high cost basis upfront makes 0 sense. In that case, you are far better off rolling it all into an IRA to keep deferring the taxes. Second, consider your overall tax bracket. If you move company stock to a brokerage account, you owe ordinary income tax on the cost basis that year. Do you have the cash outside your retirement account to pay that tax bill? Do not use the stock itself to pay the tax bill if you can avoid it. Third, remember investment risk. Holding too much of your net worth in a single company stock is extremely dangerous in retirement. The goal of retirement is security and peace of mind. If you use NUA, you can sell the stock inside your brokerage account to diversify, but the moment you sell, that capital gains tax bill comes due. Here is your actionable takeaway today. If you hold company stock in your 401k, do not touch that account, do not request a rollover online, and do not sign a single form until you request a detailed cost basis statement from your plan administrator. Take that statement directly to a qualified, fiduciary CPA or financial advisor who understands NUA inside and out. Have them run the exact calculations for your specific tax bracket before and after retirement. Money moves fast, but tax mistakes are permanent. Stand up for yourself, protect your money, and make sure every single dollar you earn stays right where it belongs, in your hands.